All right. Hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks, and this is our options midweek update. Wanted to jump on here. We have a very busy afternoon with the Fed statement out on interest rates. Sorry about that. Trying to turn some alerts off on my trading computer and the joys of doing something live with the market moving. So we do have the Fed statement out this afternoon. A very big event. We know how focused the market has been on anything the Fed says, anything that the central bankers say across the world. So all focus will be there this afternoon. Not really expecting anything earth-shattering. I would be very surprised if they changed much of anything on their end. But again, anything can happen. It's 2020, right? I mean, this year has been a year of surprises, and we'll just see what happens this afternoon. We also have the uncertainty with the latest round of stimulus. Sounds like they're getting very close to a scaled back version, and I know it's crazy to talk about $900 billion as being scaled back, but it is. It is smaller than what was originally anticipated, but it's something, right? And I know a lot of people are in desperate need of some stimulus, and we'll see how that impacts markets here going into next week. Couple things to point out here. Number one, I mean, you can see on this daily chart of SPY, this is the chart that you're looking at here on the screenshot. There's been an incredible amount of good news already priced in. Going back to early November, we have seen SPY move from down here on the low, late October into early November, low right around 322.75. We reached an all-time high all the way up at 375.05 last week. That is a tremendous move to the upside. Now, that move to the upside, a lot of it came on rumors of more stimulus, right? Rumors of, vaccines being close to being approved. Well, now we've seen the vaccines start to get released here. Definitely good news. And now we've also gotten very, very close to another round of stimulus. What will be interesting to see over the next week or so, I want to see how much good news was already priced in. Does this become a sell the news type of an event? Where they bought the rumor for months, now do they sell the news over the next week or so? The timing is tricky because we're going into the end of the year. We're going to go into a holiday stretch here starting next week. Through the end of the year, you typically see lower volume. Historically speaking, people are gone. They're out of the office. They're traveling. Now, this year might be a little bit different, obviously, with the pandemic still front and center here. Are there going to be less people gone? Are we going to see volumes remain active? That'll be the wild card going into next week, but we won't know that until we get into next week's trading. Normally, when I get into that stretch between Christmas and New Year's, that is a stretch where I typically scale things back. I typically trade smaller position sizes. I focus almost exclusively on trading credit spreads, trying to get the time decay in my favor, because when volumes do lighten up, you tend to see slower price action. And if you're not careful, the time decay can crush those positions around the holidays. That's the approach that I plan on taking again this year. I want to be active just with all of the headlines out there, all of the events that we just got done talking about. I want to be active in this market right through the end of the year. I'm just going to adjust how I'm approaching things. I'm going to focus almost exclusively with credit spreads. And I'm going to plan on trading around 50 to 75% of my normal position size. So I'm going to scale back a little bit there on the position sizing. If you do plan on taking time off around the holidays, perfectly fine with that approach. I would recommend that, as you get closer to the end of the year, take a couple of days, to review where things are at and going into January. That way you don't, take that time off around the holidays and try to hit the ground running 1st of January without a pulse, without a feel for what has been going on. So, don't have a problem taking time off. I tend to try to stay close to my routine as possible. I don't like to get out of my routine all that often because, as you guys know, once you're out of a routine, it can be difficult to get back into it, right? So I like to stay as active as I possibly can with my trading as often as I can. I mean, I just don't like to go to the sidelines very much. And advance of technology has made that a lot easier in the last few years. I mean, you can now trade anywhere you have an internet or cell phone connection. So it's not something you've got to lug a computer along. You've got to spend hours a day tracking things. We can certainly stay active without spending hours a day tracking things. So let's talk through the Fed statement this afternoon. Markets will typically become very active right up to the release. And then after the release, it's interesting because you've got the official statement that is released, and then you've got a press conference a half hour later. The press conference is the wild card. You pretty much know what the Fed is going to say. I mean, it's the worst kept secret, right? I mean, everybody knows what the Fed is going to do. The wild card becomes during the press conference, during the Q&A session. You don't know what questions are going to be asked, nor do you know how those questions are going to be answered. And that is where you can see some of the volatile moves back and forth. The way that I typically handle Fed Day, I don't initiate any new trades the morning of a Fed statement. I will wait till the afternoon hours. I will wait to that last hour of the session, see what the Fed does, let the initial volatility work itself out, and then look to place any new trades during the last 30 to 45 minutes of the session. Markets will also tend to move in a stair-step fashion as well. The first move is oftentimes wrong. The first initial reaction to what the Fed does is typically wrong. You'll typically see a reversal at some point thereafter. So you just want to be cautious. You don't want to just jump right on board, 2 minutes after the release comes out. I tend to give it some time and let things kind of settle down a bit. That way I don't get caught up in chop. It's very much a day trader's environment for the first, 20, 30 minutes after the Fed statement is released. So that's how I plan on approaching it this afternoon. I will be looking for new trades this afternoon once we get into that last 30 to 45 minutes of the session. And I'll walk you through some of the charts that I'm looking at, some of the trades that are on tap for me this afternoon, should we get the market to cooperate. From a technical perspective, we are right up near the all-time highs. Yes, it's very difficult to try to make sense of this market because you try to think about it logically, and we all know what the news cycle has been. We know what the headlines have looked like. We just had a retail sales number this morning that was the worst number that we've had in a long time. We're starting to see signs of the initial stimulus wearing off, and we're starting to see weakness spread across the economy. Now, is this new round of stimulus going to be enough to prevent that from continuing? I mean, obviously time will tell there, but just from a price perspective here, markets are incredibly overbought. That does not mean we have to turn immediately. It does not mean this market can't head higher. It just means it's not statistically probable for this market to continue at this pace on the upside. We would very much like to see a pause or a pullback first. Now, we've been saying that for the last couple of weeks, and we have had some markets chop sideways, but we have had very little selling to speak of. Any dip that we have seen has been bought up almost immediately. And you can see it here on the daily chart. If we go back into last week, we did get some selling. We did briefly break the 8 EMA, which is a solid pink line. We tested the 20 period moving average. That was Friday of last week. And we have since bounced off of that level until we break some of these key support levels, until we start to see some selling into the close. And until we start to see selling across the board, we're going to continue to see a lot of these dips bought up. It's been the story now for months. And as I've talked in these sessions here the last couple of weeks, in order for us to get some nasty selling on the downside with some follow through, what we need to have happen, we need to see some of these support levels broken. I want to see across the board selling. Here we have the Dow lower, the Russell lower today, and the S&P and NASDAQ higher. There's always that area of strength that prevents any type of significant weakness. I want to see one of those sessions where we're getting across the board movement. We haven't had one of those on the downside in quite some time. I also want to see volume pick up. Volume, it's been a struggle to get above 50 million shares of late. As I've talked about here in these sessions, I want to see that number consistently in that 75 to 100 million share range. In order for that to happen, we're going to need to see some selling pressure kick in. The volume today here midday, it's actually 26 million shares. It's not anything record breaking, but that's actually a better number than what we've seen here on some of these recent sessions. So I will certainly see volume kick in during the last hour of the day after the Fed statement comes out. So we'll see if we can get the volume to pick back up. The VIX remains elevated, remains above 23. There is still uncertainty being priced into this market. Even though we haven't seen equities pull back, volatility is definitely painting a picture where, there's some warning signals out there. If you don't have some protection on, if you don't have some put positions on, if you haven't lightened up on some of your bullish positions, the market is clearly giving some signals here that it's tired. Again, I'm not saying you just take all of your long positions off, not saying that, but you just want to be cautious at these levels. It's made a heck of a run to the upside, and you don't want to get greedy and end up giving back all of that profit. So one of the trades that we took here, couple of overnight pop trades that we took yesterday. Let's talk about these here a moment. The overnight pop trades, for those of you that are not familiar with it, if you've not heard me talk about it, these are trades that we're looking to put on going into options expiration. SPY is one of, it's the only product that has multiple expirations each week. It has options that expire every Monday, Wednesday, Friday. Come yesterday afternoon, we came in, we took a look at selling an out of the money put spread on the options that expire here this afternoon. Selling an out of the money put spread is a bullish position. We were looking for a higher open. We wanted price to stay above 368 on SPY. Here's how we structured the trade. We were using the December 16 options. Again, those are the options that expire here this afternoon. We sold the 368, 366 put spread. All that means is I'm selling the 368 put and I am buying the 366 put at the same time. Trading two options at the same time. We collected on this trade, we collected around 52 cents or $52 per spread. It tied up just under $150 of capital per spread. Very reasonable trade regardless of account size. When I put on a credit spread like this, I am targeting between 50 and 75% of my max profit. In other words, whatever price I collected to put the spread on, and yesterday, in this case, it was 52 cents, that is the most I can make on the position, $52 per spread. The only way I can make that $52 is to hold all the way up to expiration. That's not, excuse me, that is not something I want to do. If I can buy this thing back for between 13 and 26 cents, that would allow me to keep between 50 and 75% of my max profit. What we were looking to do here earlier today, normally I would not have a problem holding into an afternoon, into the afternoon session, trying to get that 75% of max profit number. I ended up closing this trade out here early. I ended up closing it out for 21 cents earlier in the session. Now, why did I do that? I didn't have my 75% of max profit level. I wanted to make sure I was out of this trade before the Fed statement this afternoon. I didn't want to hold through the Fed statement. When you get that close to an expiration with that type of volatility potentially showing itself, I didn't want to get caught and end up taking a full loss on a trade that was a partial profit that morning. I would rather book the profit, free up the capital, and take a look at the next trade after the Fed statement is released. So I ended up taking the partial profit. Again, 21 cents is where I got filled at. So it was around a $31 profit or so. So $31 profit per spread. Sorry, guys, I had to take a drink. My voice is going here today, unfortunately. So we took the trade off. Definitely will be looking for another overnight pop trade Thursday afternoon into Friday, not only on SPY, but we can trade any stock or ETF that offers the weekly options. And then this week, we actually happen to have the December monthly options expiring on Friday. So we have a whole slew of products that we can look at Thursday afternoon into Friday. The overnight pop trades, one of my favorite trade types to take. So that was a trade that we put on yesterday afternoon. We closed out here this morning. We also took a second overnight trade with our ETF service, and this time we used an iron condor. We actually came in and we sold an out-of-the-money call spread and an out-of-the-money put spread at the same time. We sold the 372, 374 call spread, and we sold the 367, 365 put spread at the same time. The goal on this trade is for price to stay in between the strike prices of the options that I sold. I needed price to stay between 367 and 372. Well, price is currently sitting just below 370. It's right inside of those short strikes. We sold the spread yesterday afternoon for 56 cents. $56 per spread is what we collected. It's currently trading for 26 cents. We're right around 50% of our max profit potential. This is another trade that you could potentially close it out if you wanted to. Just like I talked about earlier, if you did not want to hold through the Fed statement, you could certainly close out of the position and take the partial profit. So that's another one. The overnight pop trades have done really well for us over time. We're going to have losers along the way, certainly. But it's a nice way to generate some income overnight. They aren't going to be huge winners. They're not going to be 500% winners. But when you start to add these up, you take multiple trades a week, it can add up to a nice little supplemental income. And depending on your position size, potentially turn into a full replacement income. So it's one of my favorite trade types to look at. So SPY, 2 more winners for us here today. Let's move back over to the 195-minute chart. This is the chart that I actually trade off of. This is the one that I look at for my entry and exit points. You can see here on the 195-minute, this is SPY. This is the S&P 500 ETF. Very overbought, no doubt about it. None of that has changed from when we connected on Friday last week. Very overbought. What I'm looking for here, we briefly had price action close below our AEMA. That's that red and blue line up at the top. The problem with that move, anytime that we have tested that level or briefly broken that level, it has led to another wave to the upside. It's been that way now, really going back to March/April of this year. Any dip that we have had has been a buying opportunity. I still think there's massive room on the downside here for a decent sized pullback. I don't think the market's going to collapse, but I think there's a very tradable move coming to the downside in the very near future. What am I looking to have happen here for me to get aggressive on the downside? Couple things here. Number one, I want to see our trend strength histogram down at the bottom flip from blue to red. Once that happens, that indicates to me that bearish momentum is starting to take over. We briefly had, you're going back into last week, we briefly had some movement down below the 0 line on the trend strength. If I zoom in, you'll see that we briefly had red bars plotting there. They didn't last long. I mean, they lasted 1 candle, then the markets moved right back to the upside. If we can start to get some red on that trend strength histogram, if we start to see price action back below the AEMA, that would have me interested in potentially getting bearish in the near term. Okay, so that's something that is on my radar for the rest of this week. Could I also come in and take a look at selling an out-of-the-money call spread? Absolutely. I think the index products, the two that I am most interested in at this point, IWM, which is the Russell ETF, and SPY, the S&P 500 ETF. I think there's opportunities on either one or both of those to potentially sell some out of the money call spreads. If I'm going to buy long puts, I'd rather see price action confirm first. I need price action below the AEMA, and I need the trend strength histogram to go red. So that's what I'm waiting for there on SPY. IWM, the Russell ETF, it's been a historic move. We've had a lot of products that have had historic moves here over the past few months. And IWM, the small caps, have been on fire going back to late October. We have gone from late October, we went from a low around 151 all the way up to just under 200. That's a huge move for an index ETF. As a result, we are overbought. Same story on IWM to what we just talked about over on SPY. If I want to be bearish here, I need to see price action confirm. That would come from the trend strength histogram going from blue to red. It would also come from price action closing below my signal line, that red and blue line. I have to have that happen first before I go ahead and jump into long puts. If I wanted to sell an out of the money call spread, that's the route that I would rather take here at this point. For a few reasons. Number one, I mean, we are going into a holiday stretch over the next few weeks. Things tend to get choppier during that stretch. I want to get time decay working in my favor here. So let's go ahead and go over to the trade page on IWM. And let's go ahead and take a look at the January monthly options. Those are the options with 30 days left to expiration. That's where you're going to find the best liquidity, the best volume, the best open interest. And that's going to help me get filled on trades faster and at better pricing. If I go take a look at the January options, let's go to the out of the money calls. And I'm going to go to Let's start out with the 199 calls. Why did I go there? One of the columns that I have on my trade page is the probability out of the money column. And I'm looking at the 199 calls because they have around a 66% chance of closing out of the money. My starting point when looking to sell a credit spread is I'd like to sell the option that has around a 65% chance of closing out of the money. If I right click on those options, go to sell and go to vertical, it's going to pop up an order down at the bottom where I'm selling the 199 call. And I'm going to go ahead and buy the 201 call. I'm going to trade a $2 wide spread. Stretching it out to a $2 wide spread allows me to collect a little bit more premium, give myself a bigger profit potential on the trade. And this one's currently trading for 74 cents mid-price. $74 per spread is what I would be collecting to put this trade on. I'd be risking $126 per spread. My break-even point would be at $199.74. I make money on this trade as long as IWM stays below $199.74 over the next 30 days. As time passes, the time decay adds up in my favor. If volatility decreases, that works in my favor. And then I also make money. I don't care if the IWM moves up, down, or sideways. As long as it stays below $199.74, I make money. Any of those three scenarios directionally would work out in my favor. So I give myself 5 ways of making money on the position. Even though it's not a home run profit potential, I'm tying up less capital. I'm giving myself 5 ways of making money. So it's going to give me a higher probability of success. And this is the type of trade that if I want to lean a little bit bearish, given how overbought this market is, this is a better trade for me. It's a better trade because I give myself a more forgiving outcome. If I am dead wrong, if IWM continues to move to the upside, I have around a $6 cushion. It can move up an additional $6 on this trade before I'm in trouble. So there's just a lot to like about the position. Now, I've had this question come up over the past week or so. If I sell an out of the money call spread like this to lean a little bit bearish, what if price action does pull back? And what if my trend strength histogram goes red? Price action breaks below the 8 EMA. Would I be open to adding to my position? Would I be open to adding a long put at that point? Absolutely yes. There are many times, especially in an active market, there's many times where I have multiple positions on one given stock. IWM, SPY, Apple. These are products that it's not uncommon in an active market for me to have 2, 3, 4 different types of positions on. It's not something you have to do, but in an active market, you have more flexibility. There's more that you can do. So I personally like to take that approach, spread my risk into multiple trade types. It allows you to have an added layer of diversification. Now, if we collect $74 per spread on this trade, what is my target level? Well, I want to buy this thing back for between 18 and 37 cents or so. That would allow me to keep between 50 and 75% of my max profit. Okay, so I would start out my closing order at 18 cents. Anytime over the next 30 days, if we can hit that 18-cent number, we can go ahead and close out of the position and book the profit. Yeah. Hi, Tom. And yes, anything can happen in this market. Nothing surprises me. I mean, it's amazing to see these overbought conditions, but nothing surprises me these days. It's just been a truly an amazing market. And Tom, you've been focusing on stocks with P ratio less than 30 as possible protection from so much overbought. Yeah, I mean, I think there's a number of ways that you can do it. I like to diversify not only with the products that I trade, but also with my trade types and my expiration cycles. Definitely want to have some protection on here. I mean, I'm not saying you have to be 100% bearish, right? I mean, the price action has been ultra strong here, but I think at these levels, it's really difficult, to continue to chase higher day after day, week after week. So having some protection on there, I definitely think is a good idea. Ashraf, what are the names of these indicators? So let me go back over to the chart. The red and blue line up at the top, that is the 8-period exponential moving average, just with some custom coding built in. It plots blue when it's moving to the upside. It plots red when it's trending lower. The white and yellow line up at the top, that is the 50-period EMA. It plots yellow when it's uptrending, and it plots white when it's downtrending. The red and yellow histogram down at the bottom is what we call our pulse histogram, and it identifies overbought and oversold extremes for us. When it starts to plot yellow, it indicates price being between a 1 and a 2 standard deviation move. In other words, it's an overbought or oversold condition at that point. It will plot green when price is between a 2 and a 3 standard deviation move. And it'll plot blue when we move past a 3 standard deviation move. So it helps identify extremes for me. And then down at the bottom, the red and blue histogram, that is what we call our trend strength histogram. It'll plot blue when we have bullish momentum in place. It'll plot red when we have a bearish momentum in place. All right, couple of individual stocks that I have been looking at. Electronic Arts, symbol EA. Speaking of overbought conditions, I mean, look at this move to the upside. Phenomenal. Understand the whole fundamental side of it, right? I mean, we've got so many areas that are locked down, all right? So you've got a lot of these gaming stocks that have been very attractive, right? Their sales have been impressive. Well, EA has had an impressive move the last few weeks specifically. And notice here on the pulse indicator, it went from red to yellow to green. Once it plots green, price is between a 2 and a 3 standard deviation move on the upside. In other words, we're overbought. Doesn't mean EA can't move higher from here. It just means it's not statistically probable. Odds favor out of this pattern. Odds favor either a sideways move or even a reversal in the other direction, in this case to the downside. Could you wait for price to break the 8 EMA before you jump into a position? Sure, I wouldn't have a problem with that. But because we're at such a strong extreme here, this is another one that I am taking a look at selling an out of the money call credit spread. Going out potentially, and let's just mix it up. Let's see if the January 8 weekly options here doesn't have great liquidity, which may be an issue, but let's just see what we have here. These are the options with 23 days left to expiration. If we go out to the 145 calls, I'm looking at those because they have a 65% chance of closing out of the money. I'm going to right click, go to sell, and go to vertical. Take a look at selling the 145 or 147 call spread. Trading for right around 61 cents. I would be okay with that. $61 per spread would be my maximum profit potential. My max risk is $139 per spread. And I would make money as long as EA stays below 145.61. I don't care if it moves up, down, or sideways. As long as it stays below that level, I'm okay. I also make money from time decay adding up and from volatility decreasing. So now I've got 5 ways of making money on the position. It allows me to lean a little bit bearish. It allows me to put on a trade that would benefit from a period of consolidation or a reversal in the other direction. And I'm able to do so with a defined risk trade. Lot to like about this position. The only move that hurts me is a move above 145.61, which we're not expecting because the market is already so drastically overbought. This is a way to lean a little bit bearish with a more forgiving trade. I don't need a big move lower here to make money. All I need is EA to stay below 145.61. So that's another trade on my radar for the next couple of days. Spotify. Another trade that we've talked about on and off here in these weekly and midweek updates that we do. This is another one. Notice what happened here is when these yellow bars started to plot. It didn't reverse immediately. We did see price continue to move higher for another week or so. But look what's happened since. We started to level off here up around 340 and have pulled back since. Pulled back off of those overbought conditions. This is a very typical pattern that you will see out of an overbought condition. So this is another one that not only would you have an opportunity to sell a call credit spread, but we also have our trend strength histogram down at the bottom going from blue to red, indicating bearish momentum taking over. Price action is below the 8 EMA, and we did hit our entry point. The entry point is identified by that blue plus sign on the chart. This is another long put opportunity if you wanted to. Now, I wouldn't do anything now. We've got the Fed statement out here very shortly. But come this afternoon, come that last 30 to 60 minutes of the session, this is also a name on the radar for a bearish position. Jitu, can we get this chart set up? Yeah, you certainly can. If you want to send me an email to mike@netpicks.com, I'm more than willing to get you more information on the indicators that we're using here. Beyond Meats, symbol BYND. Another one that's it's been in an indecisive, choppy, sideways pattern. Call it whatever you want here. Over the past month or so, we have just been pinned right around the 140 level. It's what we call the coiled spring pattern. Out of this pattern, we will see a decent size move. We just don't know when that's going to happen, nor do we know in which direction it's going to happen in. What I'm waiting for here, I want to see the trend strength histogram either go blue or red, and I want to see price hit one of our blue plus signs. Right now, we're getting a long setup. Entry point being at 141.98. If that level's hit over the next few days, this would be a trade that I would be interested in. All right. Now, the trouble here is we don't know how long this sideways pattern is going to stay in place. We do know that when it breaks, we're going to get a very tradable move. So I've been watching this one closely over the past couple of weeks. Haven't done anything yet, but definitely on my radar, because I do think when this thing does pop, I do think we're going to get a very tradable move. So definitely on my radar here over the next couple of weeks. And then finally, Tesla. I mean, Tesla, been the probably the most popular name in the market, right, with active traders. It's been ultra active. We do have it being added to the S&P 500 here come Friday of this week. Everybody's been waiting for that. It's been on an impressive move to the upside. Very, very overbought. This is another candidate for a call credit spread, because we have these yellow bars in the pulse indicator. Look what's happened since those bars started to plot. Once we hit that overbought extreme, once we got those yellow bars in the pulse, price action started to move sideways. Haven't really seen a huge pullback yet, but very typical. We don't need to see a big pullback for a call credit spread to make money. But if it does happen, if we do get a further move to the downside, it will just allow us to make money faster. So I'd love to see this thing pull back. I think Tesla, IWM, EA, I mean, these are some of the most overbought markets that you will see right now. So I definitely am looking at each and every one of these for trades here between now and the end of this week. Tom, I just saw your comment. Good to see some juice in the premiums. Yeah, I mean, what's interesting is the VIX is above 20. It's above 23, which is normally a great range. Normally, when I see a VIX reading above 20, I'm selling call spreads, selling put spreads left and right. Selling premium is the way to go. But volatility has been so elevated now since March and April, it's almost the new norm, right? So historically speaking, yes, the VIX is elevated, but I'm not seeing, other than a few exceptions. I mean, you take a look at some of these active markets like a Tesla. There's some good premiums to collect, but I would definitely like to see another leg higher in volatility. I'd like to see some of those premiums get elevated again going into January. I think that would be, well, number one, it would open up more opportunities for us for selling premium, but it would also most likely lead to an expansion in range. We're seeing markets slow down here near the highs. I want to see things pick back up. I want to see some two-way price action to kick back in. So definitely want to see volatility uptick going into January once we get past the holidays. All right, guys. So if you have any questions on anything that I've covered here today, let me know. Feel free to type those into the chat. If you're watching the recording on YouTube or Facebook, feel free to post a comment there on the video, and I will certainly get back with you right away. My email is mike@netpicks.com. I can certainly reach out and help with any questions you have that way as well. I will jump back on Friday as we wrap up the week for our weekly recap. Take a look at what the markets do in reaction to not only the Fed statement here today, but then also hopefully at that point, we've got more clarity on the stimulus plan. So I'll be back here midday on Friday for our next session. Love to have you join us. If you have any questions between now and then, let us know and we will be in touch right away. So enjoy your afternoon, everybody. Good luck trading here this afternoon with the Fed, and we'll talk to you all on Friday.